Again, a special thanks to the folks at Epic Street for hosting this event. Thank you very much for giving me the opportunity to speak today. This is my latest in several webinars. I do about 4 a week with Epic Street. Monday, Tuesday, Wednesday, we start at 1 p.m. New York time, about an hour after London close. On Thursday, actually, it's Thursday my time, Friday for many of you. I do one more at essentially the Asian Open on Friday. Friday Asian Open, 8 p.m. New York time on Thursday is the start of that. And let's dispense with a kind of an informal disclaimer here, and then I'll give you a little bit of a format, especially if any of you who are new, as to how this webinar unfolds over the next 45 minutes, and then we'll get into the meat of it. First of all, let me clarify, this event, I am not an alert service per se. I'm not going to provide specific trade recommendations, but we're going to conduct some, in retrospect, some fundamental and technical analysis, take a review of what's happened over the course of this trading day, which is still Monday. And we'll take a look ahead to tomorrow, maybe the next couple of days, even a little bit beyond that. I may talk about some things occurring later this month and early next month, especially as it regards to Europe. So here's what we do. We'll take I usually focus on the New York morning session, number one, because that's the session I coach is part of the New York morning session, and the session I trade the most happens to be in the New York morning session. I will refer to any trades or any setups or price action which occurs during Asian and London session. And it's just that I admit that when it comes especially to the London session, I typically don't trade that session. I'm not, awake and around and at charts at the time, so I don't quite give it the you might say the flavor of any review of especially a London session. I can't quite give it the flavor that I can give to the review of a New York morning session, because I just I didn't live through the price action. The news flow, price action, volatility, lack thereof. When you're not there. I mean, I can refer to it in hindsight, but to me, it's just different when you're not living through the market as opposed to when you are, as I was today, for example, or during today's New York morning session. So anyway, summary. There was some of you may notice there's lots of gaps. Thank you, Maud. Hey, Maud, I owe you an email. I apologize for that. I'll give you a response. I got to notice because you'll see a reply from me reasonably soon after today's webinar. Gaps. See, let's talk gaps here. Uh-oh. Just a couple of you have sound. Somebody does have some sound. Could someone please recommend to Seekju, I may have mispronounced that name, Seekju, that he or she log out and log back in? In the meantime, let me activate my cursor, which you should see now. I'm focusing on the euro in particular, but the gap I'm about to describe applies to multiple currency pairs, not just the euro. I'm expanding the 15-minute chart without indicators, and using this view, you can just see the gap between Friday's close. Yes, these exactly haven't filled the gap. The gap between Friday's close, the close in the New York afternoon last Friday, and today's Asian session open, early Asian session open. That gap was never filled. Our chief currency coach at Epic Bootcamp, Wayne McDonald, was talking about this, and he was trading for a gap fill. Well, let me give you a little history on gaps. First of all, what's the idea behind the gap play? Well, many traders like to trade gaps on the gap between any gap which emerges between the close from the Friday of the prior trading week and the open of, in this case, the Asian session on Monday, Sunday evening if you live in the Western Hemisphere. Now, so these gaps emerge sometimes, and almost always, at least at some point, often on the Monday. After the Asian session in which the gap is created, that gap is filled. But not always. Not always. Let's look at a daily chart here. One notable gap that I see that didn't fill till like Thursday of that week, usually you see my cursor near the middle of this chart. And I'm highlighting the close on July 8th, Friday, July 8th. And notice the open on Monday, July 11th. The euro dropped for the next not quite couple days. rose Wednesday of that week, and again in the middle of July, and finally closed the gap. Finally closed the gap on Thursday. The gap created by between that that Friday's close and Monday's open in early July. And that's just one example. I recall some other examples. There was an example, I believe, in this past spring where a gap was created and didn't close right away. I'm not seeing it right now, but I do recall at least one. So the point is this: that, there are such there's sort of some traders have rules of thumb like that gaps will fill, but folks, they don't always. Incognito, that was our chief currency coach that posted that, not me. I'm not trying to point the finger at him, but that wasn't me. You know what? And I've been clear about this at our live trading class at FX Bootcamp. I've never been a gap fan. I've never been a big fan of trying to trade gaps. I'm not saying that they don't fill. I'm not saying it isn't a viable strategy. I don't do it. In fact, let me make a point about Mondays here, and this is we're going to get to at least one trade that came together during today's New York Money session. For those of you who don't know, I've done some studies on this. I haven't done one recently, but I did a study on this, I'd say about 8 or 12 weeks ago. About 8 or 12 weeks ago, what I found was this. I've done this study multiple times over the course of my coaching career at FX Bootcamp. And what I've looked at is this: volatility by day of week. Volatility by day week. So I use the Euro USD as an example. I'm using the Euro as sort of a proxy for the currency market. So I look at the Euro USD currency pair. I look at the range, the high minus low for each day of the week on average. So I've looked at last time I did this, I think I looked at something like I looked at the Mondays, all the Tuesdays, all the Wednesdays, all the Thursdays, all the Fridays for about a year's worth of trading. And what I have found pretty consistently is this, every time I've conducted this study: Monday on average, the lowest volatility day of the week. In other words, the range on the Euro USD, and again, I'm using the Euro as a proxy for the rest of the currency market, so the assumption is that most currency pairs, most other major currency pairs are like the Euro USD in this regard. The range on Monday, usually the lowest on average of all the days of the trading days of the week. Monday ranges usually smaller. In other words, the Euro USD moves less on Monday on average than it does on any other day of the week. So that's one point to always keep in mind. That doesn't mean that the Euro's, it doesn't mean on every single Monday you should abstain from trading the Euro. It doesn't mean that there's never going to be a big move. It's just that on average, the Euro doesn't move. Now, somebody may think, well, why is that the case? Well, one theory, at least in my mind, at least one theory behind that, news flow is pretty light on Monday. News flow is pretty light on Monday. Monday usually doesn't offer much in terms of the news calendar. You don't see a whole lot of reports released on Monday. Another theory that I would suppose is that maybe it's something to have to do with the size of the moves near the end of the week. It's unusual, and of course this may relate to news flow. We do tend to get more and more news flow, economic reports and other types of news flow, especially these days from Europe. But we tend to get more news flow later in the week, and which can then affect price action. Even if there is news flow, whatever the case, price action tends to be greater as we approach the end of the week, particularly on Friday. Although Thursday historically has been a very close second to Friday in terms of the biggest day of the week for the Euro USD. Here's my point. So when you have one common pattern of price action, big moves when and if they do occur near the end of a trading week. Big moves regardless of when they occur. Big moves can be followed by some consolidation, just limited price action, lower volatility. So maybe that's one of the reasons why Monday is relatively tame compared to the rest of the week. You tend to get bigger moves. I mean, not always much bigger, but somewhat bigger moves in the latter part of the week. So, and again, a common pattern of price action on virtually any time frame is big moves are eventually followed by some form of consolidation, lower volatility, kind of range on price action. So anyway, there's your lesson on Monday, at least what I found historically on Monday. Now, these such rules of thumbs like this. I've talked about, gaps being filled. I've talked about volatility on Mondays. These rules always worth checking. And, it's one of the things that I see that amateur traders, one of the biggest mistakes they make is adopting a rule of thumb or adopting a particular favored indicator. I don't know, stochastic, MACD, whatever, RSI. Pick your favorite indicator, or maybe it's a particular currency pair. I remember comments by traders in our room. I remember someone said months ago. It just stuck out in my mind. Someone said months ago that pound yen had paid them so well in months and years past. They still trading pound yen. Well, my point is this, and it's something even I have to remind myself every day. You've got to recheck your assumptions, and this is worth repeating. You have got to recheck your assumptions, whether it's the health of economies that can dictate money flow, which money flow is important to the currency market, whether it's indicators and which ones work best in different trading conditions, or the pair you trade. You may have a month when you are just killing it, so to speak, trading a particular currency pair, and the next month you're expecting a trader can expect more, trying to expect more of the same from that same currency pair, may not get it, and that trader can continue to apply the same expectations, the same tools, that currency pair that has already been through a big move or a lot of price action, and maybe start doing something different. It's recognizing when things change and adapting to the market. That's one of the biggest things I see traders not doing enough of. So I hope that helps. So the DZG, I mentioned Thursday. Last time I did a study, Thursday was the highest. But the time, most times I was conducting the study before that, Friday is the highest. So I would generalize and say the end of the week, Thursday and Friday, interchangeable. The end of the week tends to be more volatile than the beginning part of the week. And again, that doesn't mean there aren't trades on Mondays. In fact, let me go right away before I move on to something else. Let me move to the euro yen. Actually, before I move to the euro yen, let me take you to a step back to something I noticed during my coaching session today before I made reference to the euro yen. We're going to take a look at an hourly chart for the yen crosses. Incognito, I like that latest comment. Oh boy. I guess we all have our own indicators, huh? Yeah, I'm looking at hourly charts for the major yen crosses. And of course, these charts include price action from today's New York morning session. But what I noticed, let me zoom out a little bit on these charts. These are on the top two charts, hourly charts without indicators for Aussie yen and CAD yen. On the bottom, hourly charts without indicators. I adjust the zoom here for pound yen and CAD yen. And notice, by the way, there's at least two yen crosses here two I can see. Aussie yen, pound yen, Aussie yen and euro yen. Gaps in those pairs never filled. Unless you count the filling of a gap of the early Asian session high on the euro yen with last Friday's low. But again, I honestly don't bother myself that much with gaps. And I can tell you for what it's worth, I don't trade that much on a Monday. And for one of the reasons, it's the lowest volatility day of the week. I'm more picky about my setups. I'm more of in a scalpy mood, unless there's some major news flow pushing the market and obvious signs of and especially correlated volatility. Monday is a pretty slow day for me when it comes to trading. But food for thought there. So I'm looking at the yen crosses, and I was looking at them. Let me count my hours here. About 7 hours ago, I was looking at the yen crosses about 7 hours ago, and what I noticed was there was some correlation amongst the yen crosses as of that time. The yen crosses as of about 7 hours ago, it wasn't great correlation, but they were generally moving in lockstep, and that's something I haven't seen as much in quite a while. Actually, I have not seen that much of what the quants call correlation. Think of it as go-togetherness. I can actually, I was going to do an overlay chart, but I'll pass on that for now. I can if you want me to. If there's any request that I show an overlay of like euro yen with another yen cross, I'd be happy to. My point is this: the yen crosses as of about 7 hours ago, 6 hours ago, were generally moving in sync. They were generally moving in sync with each other. They're both more down than up. And I found that striking because so many days, especially last week, and as I've called even the week before, so many days recently, the yen cross was sort of doing their own thing. You'd have it, I remember seeing days recently where, like, as of the early New York morning session, you know, Aussie yen would be flat and Euro yen down or pound yen up or CAD yen doing its own thing. I mean, that, when I see price action like that, when the different yen crosses kind of have their own character, doing their own thing, that tells me the Japanese yen is not in control. The Japanese yen is just not in control of those pairs. Today I saw some of that. We saw some of these yen crosses moving in lockstep with each other. We saw some correlation. So there was reason to give these yen crosses a closer look today. And the fact that the yen was at least slightly broadly strong, it makes some sense considering what was happening, especially in the European financial markets, particularly equities. European equities were down as of about 6 or 7 hours ago, and that downward mood kept going. That so-called risk-off mood kept going through today's New York morning session. So again, for me, it was the combination of you saw some correlation in the yen crosses, you saw some signs, and around like the so-called London lunch, and in the early around the New York Open, you saw some signs of some broad strength in the Japanese yen, and you had a risk-off mood in Europe. So it was not unreasonable at all to be looking for an opportunity to buy the Japanese yen. And needless to say, because with all the concerns in Europe and certainly nothing positive that I could see over the weekend that could cause prompt one to be overly bullish on the euro itself, it was reasonable, at least in my mind, to look for an opportunity to short the euro yen. So I'm going to take a look at the euro yen here. And the simple setup, I'm going to show you on the chart without indicators. And of course, I'm showing a daily chart here, which I don't want to show. I'm going to go to a 5-minute chart, but you can see the same thing on a 15-minute chart. Maybe I'll go to 15 and zoom in a little bit on this chart. So I back down on the 15-minute chart. Here's what I was seeing. If you look at the 15-minute chart, as the trading day progressed, first you had Asia. You had Asia pushing this pair down, not in a big way, but still pushing this pair down. Then London started with a bearish mood, push this pair down. And just a few minutes after 9 a.m. New York time, here's what you had. I'm looking at let me really color this line so I can call out these different levels here. I've got a line at about 104.70. Then I'm going to give it a blue color so it stands out, so I can highlight that. So today's today's London session lows. Today's London session lows around 104.70, and I've got my horizontal blue lines at 104.71. I think you get the idea there. I'm going to add a red arrow to highlight specifically today's London session low. So some of you may recall, I mentioned this, I believe at least in one of my webinars at FX Street last week, role reversal. Example of role reversal. In this case, the scenario was what was support during London session trading, later during the New York morning became resistance. Support became resistance. Let me add another red arrow, this one pointing down, and there you go. Support became resistance. In fact, what I find interesting, and this does happen on multiple major currency pairs, obviously not just the euro yen, you can have a pair like this confirm support in the context of a downtrend. Eventually support breaks, and then resistance is tested not only once but several times. By the way, U.S. 10-year T-note at 1.93%. Bonds have been on the up, but not catching a bid today. And what I found interesting, this happens often enough to watch for it, and even to create a trade plan based in part on this. What I found interesting, let me go down to a 5-minute chart and emphasize this. What I found interesting is that you had a chance to short right at about 104.70 minutes before the opening bell on the New York Stock Exchange. I'm sure at least a few of you have heard me say, whether you're a boot camper, maybe you've heard me say it in live class, Maybe you've heard me reference it in one of my New York session reviews. I believe I've said it at least once, maybe twice here in one of these Epic Street webinars. Volatility, it's not uncommon at all for volatility to increase starting minutes before and minutes after the U.S. equity market open in the currency markets. Now, any one of you can come up with any valid or maybe, odd explanations as to why that is. I have some of my own theories, but that's not the point. The point is this. It has been very common this year, especially at major pairs like the Euro-USD, it's been pretty common for volatility to increase on major currency pairs, especially the Euro pairs, the volatility to increase starting minutes before or minutes after the U.S. equity market opened. So the chance to short around 104.70 came together during the first hour of today's New York morning session. Also a chance that you see my cursor next to now, another touch of that London session low just minutes before, I think it was about 10 minutes before the opening bell on the New York Stock Exchange. And then finally the yen woke up and down we went. In fact, what made this move, what I thought made this move interesting is because some of the last stretch to the downside of this move, that materialized, and let me go to the chart showing this. The euro yen made its last stretch down after, I'm going to expand the chart here for the dollar yen, after the dollar yen broke below the 76.50 zone. It's just call it a level. Now, you may ask, what's the big deal with 76.50? Well, let's look at a daily chart and show you that and talk about that. I'm looking at a daily chart for the dollar yen. And maybe it's just me, but it seems like there's been several touches. There's been several daily candles whose bottoms are at or near 76.50. This is going back to early August. Now, there's been some times when the dollar yen has found support closer to 76.30, and of course we had a break in mid-August, a brief break below 76, the psychological level. But there's certainly been more than one day where the dollar yen has found support around 76. So some of you may think, well, what's the dollar yen have to do with this? Well, I have found the dollar yen is a pretty good proxy for the yen crosses. When the Japanese yen is in control, when we have correlated moves between like euro yen, pound yen, Aussie yen and such, and dollar yen, the dollar yen will not always but often enough dictate the end of a move. So, for example, I haven't seen it as much because the correlation amongst the yen crosses hasn't been quite as good lately. The yen crosses haven't moved quite in lockstep, and the Japanese yen has been, although to a great extent, relatively dormant, maybe due in part to the threat of intervention by the Ministry of Finance of Japan. Nevertheless, what I've seen historically is that two things. Number one, when the dollar yen breaks, or at least pierces a significant, in this case, area of support, you see the other yen crosses follow suit and drop. Broad yen strength. The other scenario is when the dollar yen decides, whatever the direction of the move, the dollar yen decides it's done. In this case, when the dollar yen drops and done dropping and then turns up, the other yen crosses will follow suit there as well. So yeah, it is a danger zone, but DZG, here's my thinking on the Japanese yen is this. Is there still a lingering threat, if you will, of intervention by the Ministry of Finance in Japan? Yeah, that's a very reasonable assumption that there's still a threat of intervention. What I find striking is that, a couple of things. Number one, Japan's been quiet ever since the Swiss National Bank piped up and started doing some things. Swiss National Bank threw about everything but the kitchen sink at the Swiss franc, and eventually, this was not last Tuesday, but the Tuesday before this, 2 weeks ago tomorrow, Swiss National Bank said enough is enough. We're putting a line. Actually, we're going to put a concrete floor at 1.20 for the Swiss franc against the euro. That's it. So the 1.20 effectively is ceiling for the Swiss franc against the euro. And they use some pretty bold words to describe how committed they are to keeping that line, that support line, at 1.20 on the euro Swissy. By comparison, you haven't heard such strong words, such a strong commitment by the Ministry of Finance in Japan. At least not yet. Well, the other thing to consider is this. We've had a sort of musical chairs in Japan. It's something I'm sure some of you probably know. The former finance minister in Japan is now the prime minister of Japan. And so there's been a change in the guard there. And, I don't know whether it's, is the new prime minister of Japan, is he like, still reading the instruction manual on how to be a prime minister? I don't know. I suppose he's got a lot on his plate, and maybe the new finance minister is still, figuring out where the restrooms are. It's hard telling. But my point is, there's been some change in the guard, if you will, in Japan, and that might have a little bit something to do with the what's going on. Also, I wouldn't be surprised if Japan's waiting to see how maybe the story in Europe plays out, and for that matter, even the Fed. Because think of it this way: there's been some chatter, and I'm going to talk about this in a little bit. There's been some chatter about and rightfully so, about the Federal Reserve in its FOMC meeting starting tomorrow. The Fed very well might unleash some additional so-called quantitative easing programs, some form of policy easing in some way. One example is being called Operation Twist. I'll explain I can explain what that means in a little bit. So my point is this: the Japan might be waiting for the likes of at least the FOMC the meeting for the Fed to make its decision about its next policy move before they jump in and start doing some interventions. Not sure, but that's just one theory. Just one theory. And by the way, if the Fed does make a new policy move in the direction of policy easing, some additional form of quantitative easing, for example, which would suggest dollar weakness. Dollar weakness obviously means down versus dollar yen. That's not what Japan wants to see, but the thing with Japan is that Japan could be in a real tough spot and a difficult spot to fight the Fed if the Fed turns on the easing spigots too much. So anyway, Japan may very well be due to the political musical chairs, due to the upcoming FOMC meeting, due to the evolving, seemingly daily evolving situation in Europe. Maybe it's sort of in a let's just wait and see what happens with here. Let's wait and see what happens with the FOMC, or some combination of that. So again, the trade of the day, at least a trade of the day, as I saw it, short on the euro yen around 104.70-ish. And you could close the trade at 104, the psychological level, or maybe you just held the trade until London closed. London closed about 90 minutes ago. And as I saw it, that was about as good as it got. So I've got about 15 minutes of scheduled time left in my session here. I want to cover a couple things that I mentioned in my coaching session at Epics Bootcamp. Some of you may recall my discussion in recent webinars here about the Commitment of Traders report. I'm sure at least one of you are monitoring the latest Commitment of Traders report from the CFTC released last Friday afternoon New York time. Let me give you a look at that. Oh, incognito. There's way incognito. I'm sure you've read about the joblessness levels amongst young adults, not just in the U.S. but even in Europe. My point is this: there's problems all around here. It's not just it's not just the U.S. problem. We have much of the developed world is in a world of hurt right now. All right, you should see a graph over my GFT or over my MT4 charts. Could someone please confirm they see the graph? The graph's got a jig-jaggy sort of maroon-colored line representing the Euro USD, and also some blue vertical bars. Thank you, Michael. So you see the graph, good. And I believe I showed the graph last week. I believe last week I showed a similar graph like this, showing which was at that time the latest Commitment of Traders data. What it shows is this: if you look at the Commitment of Traders reports published by the CFTC each Friday, they show positions held by commercial accounts, especially like companies that hedge their exposure to currencies. Well, will take on positions in the futures and or options market to hedge their currency exposure. And then you have so-called non-commercial accounts, specifically speculators who are making bets for or against currencies for purpose of profit. That's the so-called non-commercial accounts. That's one proxy for hedge funds. So if you want to look at what hedge funds are doing, what hedge funds think about particular currencies, you can look to the Community Traders Report and get at least a rough proximity of what hedge funds are doing. And what I found over the weekend as I reviewed the latest Community Traders Report from the CFTC was this. If you look at the shift over the past 2 weeks, actually I'm going to get my dates straight. So if you look at the shift from, I got to check my dates here to make sure I get my dates right. Remember, I'm a quant, so I like to get my numbers right. If you look at the shift in positioning in the futures and options market, positioning for or against the euro, positioning from, I believe, would be Tuesday, August 30th to last Tuesday, September 13th. So if you look at the shift in positioning in the futures and options market from Tuesday, August 30th to last Tuesday, September 13th, the shift in positioning from sort of neutral to now net negative the euro, there's never been a bigger shift than that, at least in terms of the euro. So the market has gone from just slightly net bullish on the euro as of late August to rather extremely net bearish the euro. And again, the severity of the move, the sharpness of the move, never before seen. We haven't seen in terms of net contract short. We've never seen that much of a shift in 2 weeks. Anytime. So what does that mean? I mean, the market's really got, the hedge funds have really loaded up on euro bearish positions. Are they right? Who knows, folks? They may very well be right. Another thing, you know what? And here's something. This is a bonus for you guys. I didn't mention this in my live coaching session. I should have. I've looked at the so let me back up. So the bars represent either net long and net short positions. If you look at the blue bars on the right hand side of this graph, you can see if you look at the latest readings from the CFTC report and on the latest week reported Friday, the readings for last Tuesday, and then the week before that, the market is net short the euro. So if you look at all the positions for non-commercials, all futures positions, all options positions. I've cited an example here. There are some 26,000, almost 27,000 longs in futures plus options, and about 79,000 shorts. So the market is net short the euro. Net short the euro. This is again as of last Tuesday. And by the way, as of last Tuesday, I'm showing the line, the maroon colored line for the euro. It was fairly low last Tuesday as well. So again, I'm showing positioning in the futures and options market for or against the euro, net positioning, either long or short, and then the closing price for the euro on that same day, the same day that the positioning was reported or recorded. Any questions about that? So again, here's my point. From an historical perspective, we've never seen such a strong shift. Now, does it mean there's more to come? There could be. There could be more to come. There could be more and more hedge funds, more and more traders piling into euro short positions. It's very possible. But what's also possible, and consider this as we approach the FOMC meeting that is scheduled to start tomorrow and finishing Wednesday, if the Fed really does some sort of shock and awe type thing, does a degree of easing much greater than most of the market think, you could see one heck of a short covering rally on the euro. Very possible. Retracement in which direction? DZ, give me a time frame. You thinking retracement up of the 1,000 plus bit move down over the first 2 weeks of the year? Yeah, it's I feel like it's going to depend in part on what the FOMC does. Here's what I can envision, DZ, as a possibility. Again, this is one scenario, whether or not it plays out this way, it's all guesswork right now for me. But here's what I'm thinking. I can envision a possibility where the dollar sells off if the Fed does maybe a little more easing as announced after Wednesday's meeting than what the market thinks. But they may only set up a chance to sell the euro later. Maybe a Fed move takes the euro back up to 140, 141, something like that. Now, if the Fed does little to nothing, if the Fed underwhelms the market, this pair could be release the hounds when it comes to the euro bears. Yes, Lana, I look at the non-commercial positioning only. Oh, by the way, I was going to mention correlation. I got sidetracked. But I was going to mention something I didn't even mention in my live coaching class today. My correlation studies suggest there's about a 6 to 8 week lag on average, between positioning in the futures and options market and actual price action. Now, sometimes it's coincidental. You'll see a shift in the futures and options positioning by non-commercial accounts, just as price action is shifting from one direction to another. So sometimes it's sort of a one-to-one correspondence there. You can see the price action, the spot market price action shifting, just as position in the futures options market is shift. So it's not always a leading indicator, but on average, I've looked at correlation studies. I just did some over the weekend. I've looked at correlations between positioning in the futures and options market compared with closing prices for the Euro USD. And what I found was this: based on the correlation is closest and reasonably significant. The correlation is closest and reasonably significant with about a 6 or 8 week lag. In other words, on average, the positioning in the futures and options market can tell you something about where the Euro USD is going to be 6 or 8 weeks later. Yeah, DZ, not just an interesting week, but poised to be an interesting month. I said this late last month, and there was some clues led me to this conclusion, and I can discuss this really briefly as we wrap up this session in the next 10 minutes or so. That I was saying at the end of the last month, and I'm pretty sure I said it in here, that this was poised to be not only an interesting month, but a historical month for the Eurozone. And maybe it's not so much this month, maybe it goes in the next month. But boy, there's just a lot of stuff happening here. Some of you may recall, it was in early July, and I can show a separate graph for this. Let me cue up the graph here. I want to show you a graphic which displays Euro USD. The graphic isn't fully labeled, and I apologize for that, but the graphic you're going to see in a moment shows candlesticks. The candles show Euro USD price action through last Friday's New York session close. The red line shows Italy's 10-year government bond yield, and the dark blue line, navy blue line, shows the DAX. That's the main stock market index in Germany. What I found interesting was this, and we talked about these things. I talked about these things in my live coaching session, this FX boot camp, as it was all unfolded. One of the first things that emerged in early July, Italian bond yields spiked up, especially after the spat between Italy's prime minister and the finance minister. It was some Friday in the middle of July when those two had a little war of words, and that perception of political dysfunction in Italy, which isn't unusual, but that this new round of political dysfunction in Italy seemed to financial markets seemed to punish Italian bonds after that began to emerge. So Italian bond yields on the rise, that brought Italy to the spotlight in terms of sovereign debt concerns for Europe. And as that happened, as that was unfolding, as bond yields in Italy were rising, you saw especially the German banks begin to drop. Why? Now, it wasn't just in Germany, but even French banks especially were dropping. Why? Because Italy's government bond market is the third biggest bond market in the world behind the U.S. and Japan. And a lot of European banks, particularly those in France, also those in Germany, have high exposure to Italian government bonds. So you had sell-off in the DAX. All that, the spike in Italian bond yields, the sell-off in Germany's DAX, main stock market index in Germany, also there was a sell-off in the CAC 40, the main French stock market index. All that preceded an eventual euro sell-off, which began actually late last month. Now, where we go from here remains to be seen, but you feel like we're at sort of a moment of truth here, and then not just this week, but in the coming weeks for the euro, or for the eurozone. By the way, a little clue from the bond markets that it's worth discussing as I approach the end of my webinar here. And I may run a little bit over time, and I apologize in advance to the folks at FS Street for that, but I'll try to keep this short, although I'm not known for my short explanations. I'm going to show a separate graphic now showing a red line and a blue line. Again, you should see a graphic soon showing a red line and a blue line. The red line, that's the 2-year T-note yield. The blue line represents the 10-year T-note yield. Both were as of, I believe, the close of last Thursday's trading. So I don't show Friday's or today's price action, but this shows price action going back to the start of 2008. Here's my point. Operation Twist, what's being deemed as Operation Twist, many are speculating the Fed will do something like an Operation Twist. That involves the Federal Reserve taking, for example, its holdings of shorter denomination treasury securities, such as 2-year notes, selling them in the market, and then buying more longer denomination treasury securities, such as 10-year notes, even 30-year bonds. Now, here's one school of thought that I've seen mentioned on several sources on business channels like CNBC. Bloggers have mentioned this and such. You know, what I find striking is that it was even today, and I don't show this, but even today, the 2-year T-note yield hit a fresh new all-time low. Fresh new all-time low today on the 2-year T-note yield. I find that interesting when you consider that the Fed just might do this, given the prospect of the Fed doing some sort of Operation Twist where they would start dumping 2-year notes, for example, on the market. Well, that's not showing up. The prospect of any expectations of the Fed dumping a significant amount of 2-year notes, for example, on the market, not seen yet, not suggested yet in the Treasury market, specifically on 2-year yield. Folks, does that make sense? If there was a broad expectation of a significant selling by the Fed, dumping 2-year notes in the market, you might start to see at least a little bit of a rise in 2-year note yields. We don't see that. So now maybe that tells you something about expectations or lack thereof when it comes to what the Fed will do on Tuesday and Wednesday, or what they will announce after Wednesday's FOMC meeting is concluded. If I had to guess, will the Fed overwhelm or underwhelm? I would guess underwhelm. I think they'll do something, but I don't expect any shock and awe. But these days, if there is one central bank that's at least in a position to shock and awe, it's probably the Fed. So it's possible, but I am not optimistic. And the reason I say that, if you look at the vote as revealed in the latest FOMC meeting minutes, if you look at the vote for simply changing the language in reference to their commitment to keep the Fed funds rate low. Remember, there was a change in language back in the previous FOMC meeting in August. A change in language in reference to the Fed funds rate. The previous language said they would keep the Fed funds rate low for an extended period. The key words were extended period. At the FOMC meeting last month, they changed that language and essentially saying that they intend to keep the Fed funds rate low between 0 and 0.25% for like 2 years. Well, the FOMC voters, the voters at the FOMC who decided not to change, dissension is fairly rare at the Fed. It happens, but it's fairly rare. Well, there were 3 dissenters. There were three of the 10 FOMC members voted against that idea. They did not like it. So you may think the thinking goes like this: if there were 3 dissenters, three of the 10 FOMC voters voted against simply changing language in reference to, or simply committing to a low Fed funds rate for a longer period of time, there's probably going to be even more dissension towards any more meaningful, any more significant forms of policy easing by the Fed. So you have a fairly divided Fed, and you can almost assume that the bond market's reflecting that. So I hope that makes sense. Also, I want to leave with something. What can you chew on? What can you go with? Here's what I'm watching for. I suspect Wednesday is going to be a key day in the currency market. And actually, you could also say Thursday as well, because the one thing that most traders won't have a chance to do is react to the FOMC statement on Wednesday. So here's the thinking. I see two key news events this week that should shake at the market. And by the way, I'm not even mentioning Europe, but Europe's always a factor. So I'm going to say the same thing I said in my live in our live class at Epic Spook Camp on August 18th. I think I said it earlier, but at least I'm on record as saying it on my during my New York session video review for August 18th, posted on the Forex Street blog. I mentioned it then. Watch Europe. Watch Europe. Watch Europe. Be it news flow out of Europe. Actually, there's this. There was, I think Trade the News just mentioned earlier, there wasn't going to be any statement as a result of this Troika conference call. They were going to have today with Greece. So maybe we're going to see something eventually, some commentary emerging out of Europe as to what was discussed at this conference call between the so-called Troika, the IMF, the EU, the ECB versus Greek officials. But I digress here a little bit. So keep an eye on Europe. But beyond that, what else can move the currency market? So I see two things. Let's list them in chronological order, not in order of importance. Chronological order, the first thing coming up, MPC meeting minutes. MPC meeting minutes. The MPC is the Monetary Policy Committee at the Bank of England. And the minutes of our latest meeting that was held, was it last week or the week before? The meeting the Bank of England held earlier this month to decide on monetary policy. The minutes of that meeting will be released during London session on Wednesday. That just might provide clues as to what's on the Bank of England's mind. So if I don't know if they are, but if the Bank of England is moving closer, if the Bank of England is moving even closer now to its own sort of QE program, quantitative easing program, maybe they're looking to buy more gilts. That's government bonds in the UK. Maybe they're looking to do something else, buy some of the types of assets. If the Bank of England is moving closer and closer to that sort of step, it might show clues to that next step might be shown in what was discussed amongst the MPC voting members at the meeting earlier this month. So the MPC meeting minutes due out at 4:30 a.m. New York time during the Wednesday's London session. That could certainly shake things up for the British pound. And then that same day, later, actually after London closed that day, you've got the FOMC statement. And so, of course, the market's going to keep its eye on, what the FOMC has to say. And, will they deliver some form of easing? If so, how much? Is it Operation Twist? Is it something else? They stand pat because there's simply too much resistance amongst FOMC voting members to do. And so we will see. We shall see. And we'll talk through some what-if scenarios at my webinar tomorrow as to what could that mean. What could that mean to the actually multiple financial markets, but especially the currency market. Yeah, very possible, DZG. In response to your question about, what I find interesting is that, given the things I just showed you earlier on this graphic here, I mean, you've had some clues in multiple financial markets building here. I mean, not just these, but consider where German bond yields have been going. We've recently reached new all-time lows in the German 10-year yield. UK gilt yields, 10-year gilt yields, reached like multi-decade lows, or actually 100-plus year lows, or something like that. Of course, the French bank stocks are being impounded, and then we've seen a rise in the amount of money parked. It actually dropped off last week for a little bit. We saw a notable rise in the money parked at the ECB's deposit facility. In other words, Eurozone banks were looking for a safe place to park money as opposed to lending it out to other banks. And I liked what the Telegraph. There was an article in the Telegraph out of London. Article in the Telegraph last Friday, which said something to the effect of, this move by the more important central banks suggests something is up. Something is up in Europe. Whether call it Greece, call it Italy, call it what you want, but something is up in the European banking system. or again, it's not just Greece thing, but it's a European thing. Something is definitely up. Well, also put this and move in the context. When was the last time? Actually, the last time we saw coordinated central bank initiatives where all the central banks acted in concert to do something like, flood the European banking sector with dollars. The last time they did this was in May of last year, and that's sort of at the peak of the original peak, if you will, of the Greek sovereign debt crisis. So that they last announced a coordinated effort like this in May of last year. Before that, you'd have to go back to, October of 2008, just weeks or soon after the Lehman Brothers bankruptcy. That was at that time we saw coordinated multiple major central banks do a coordinated rate cut. Now, and to their credit, you might say they're getting a little bit ahead of the curve there. This may not be quite as reactionary as were some prior moves. But the fact that they're doing something like this, multiple central banks and a concerted move, it does suggest something ugly is going on now and could get a lot uglier. And of course, again, going back to that view of the futures and options market, you can't deny that hedge funds have sniffed that out as well. I mean, again, put the pieces together here, folks. Put the pieces together. Italian bond yields, again, Italy, the third biggest bond market in the world. Italian bond yields were spiking in Italy as of early July. Many European banks have gotten hammered since early August. Other signs of stress in the banking sector. The Euro LIBOR has been up. Again, the funds parked at the ECB's deposit facility. Those signs of stress in the banking sector. That's been up lately. And then you got that dollar rally in the past couple of weeks, maybe due in part to central banks or like the ECB or just other banks in Europe going to the open market for dollars because dollars were increasingly hard to come by. Dollars that banks in Europe were formerly getting from the likes of U.S. money market funds, but no longer getting from those money market funds to the same degree because U.S. money market funds, which have historically been common lenders to Eurozone banks, are not lending those banks nearly as much out of concern, about the sovereign debt situation in Europe. So again, I'll leave you with this: watch Europe, watch the Fed, the FOMC on Wednesday. Watch, especially if you're a pound trader, watch for the MPC meeting minutes on Wednesday during London session. And of course, given how evolving and changing the situation is in Europe, who knows? Maybe we get a surprise announcement of some kind in the coming days about Greece or I don't know, a vote by one of the Eurozone countries on the EFSF, or who knows? It's like I said, it's almost become a day-to-day thing, if not a week-to-week thing. Folks, thank you very much for your time. Special thanks to FX Street for hosting this event. I apologize for running past my time, but I hope it's been beneficial and helpful. Have a great day, folks. We'll do this again tomorrow. Same bat time, same bat channel. Cheers.